Hi, this is Melinda Flynn. I'm your Fusion neighbor and real estate broker with Melinda Flynn Real Estate. Today's webinar is on 1031 exchanges. If you're not sure what that is, Greg Burns here will explain everything you ever wanted to know. And before we get started with the presentation, we have a little word from our sponsor, Mark McLevy. He's with New American Funding, and he's a fantastic mortgage advisor and lender. Go ahead, Mark.
Yeah, thank you, Melinda. It's Mark McLevy with New American Funding, and I'm very excited to be part of your webinar and podcast today. There's a lot of options out there when you're looking for lending solutions, especially when you're looking into investment properties. And a lot of lenders out there will have a little bit tighter, more stringent guidelines when it comes to investing right now. And so you've got to be real careful. You've got to make sure that you're talking with a lender that understands the nuances and what you're looking to do with investing in additional rental income properties. A lot of those lenders will cut you off at a maximum of 4 properties. They also will look deep into whether or not you have landlord history and whether or not you've shown a track record of being able to manage number of properties. Here at New American Funding, we do not have those restrictions. We have some products that will allow you to purchase and invest in up to 10 properties. We also have some unique products that will allow you to not have a limit on the number of properties that you own. We also will not limit you on landlord history. These are all traditional products with extremely competitive rates, and sometimes we beat some of the bigger banks out there as well. So keep that in mind. Not all lenders are created equal. So
Well, we know that, Mark. You and I have been working together for 10 plus years, so I really appreciate your due diligence that you do for the buyers that we work with. So thank you.
Well, thank you, Melinda.
Are you going to stay on with us here, or?
Absolutely. I'd like to hear what
okay.
we've got.
Great. Well, we have, as I said before, Greg Burns with IPX 1031. He's an expert in the process of 1031 exchanges. He's going to explain all of that. At our Fusion complex, out of our 280 units, we do have quite a few landlords that are renting their properties out. So what happens when one of those landlords decides to sell the Fusion condo and maybe they want to buy something else, or if they don't buy something else in exchange, then they'll be subject to a certain tax, which Greg will get into. So without further ado, we'll let Greg take it over, and he has a PowerPoint presentation. If you have any questions, if you're on live with us today, feel free to send us your question via the chat, and we'll be sure that we get it answered. If it's a future time and you're watching this on a recording on our YouTube Fusion channel, and you have questions, feel free to email Greg directly. His contact information is here on the screen, or you can email me and I'll forward it to him. So go ahead and take it over, Greg. Thanks for coming.
Thank you. So I think the first place you have to start when you're talking about a 1031 exchange is, what is it, right? So, so 1031 is a section of the tax code which allows somebody that owns investment property to sell that property and exchange it for another property that they intend to hold for investment or business use. And the ultimate goal of that is to defer the payment of capital gains taxes. So it's a way that you could take money that you would normally use to pay taxes and go make more money with. So really, it's one of the last great investment vehicles that exists.
And just a quick question, since we've had some changes in our tax code, some significant changes, has this changed at all, or is this the same as it's always been for the past X amount of years?
So on the real estate side, it stayed the same.
Right.
But it did change a little bit with tax reform. So we used to, under Section 1031, be able to exchange all kinds of assets. So we would exchange personal properties. I've exchanged livestock. I've exchanged exotic cars, woolly mammoth skulls,
Wow.
anything that was held for investment or business use. In fact, the running joke was that I had figured out how to exchange everything with the exception of a husband and a wife.
Oh my goodness.
Aside from that, I'd pretty much figured out how to swap it. But so now with tax reform, personal property is now covered under immediate expensing, but 1031 for real estate has remained the same. So we worked very hard to make sure that 1031 stayed for real estate because we figure it's a huge benefit for anybody that owns investment property.
And it was up for some, changes last year, right?
Yes,
there were some
absolutely.
things that were under review.
They were definitely talking about potentially doing away with it.
And before we continue, neither one of us are a tax attorney or a tax person. So if you have questions about your personal tax situation, please consult your tax advisor. And in conjunction with Greg would be a good combination. So
we always want to make sure that we get their tax advisor involved, make sure that they're on board, that they understand the process with it. So basically the plain translation is any gain realized in exchange of like-kind property will not be taxed, which brings me kind of to an interesting point, which is that like-kind rules. A lot of people hear 1031 that I've got to buy a property that's like-kind to the property that I sold. And when it comes to real estate, that transition is very broad. So as long as I'm selling real estate that I've held for investment or business use, and I'm buying real estate that I intend to hold for investment or business use, it's considered like kind. So if I sell, a condo, I could buy a single family. If I sell a duplex, I could go buy, 4 units or industrial. It doesn't make a difference.
As long as it's another rental.
As long as it's real estate, and as long as I hold it for investment or business use, it'll qualify. So, so this is what talks a little bit about what happens in a taxable sale. So when you sell an investment property, there are a couple of things that you have to deal with. A lot of people hear like, hey, I've got to pay capital gains taxes. That's 15%. What they don't realize is that there are other taxes associated with the sale of an investment property. So the first place you start is at a federal level. So at a federal level, they tax with basically 2 different tiers. They've got the federal capital gains tax, which is due to appreciation, so what the property's gone up in value. And then there's also a recapture of depreciation tax, which is recapture some of the taxes on the depreciation that you've taken on the property. So let's say that you, what's the average size property value of the property in the complex that you?
Average about 700.
Okay.
We have some a little more, little less.
And how long has been that property been in place?
The complex is 12 years old in March.
So 12 years ago, what were those properties selling for?
Actually, they were approximately around
Just ballpark.
500.
Okay.
Yeah.
So let's say that over the 10-year span that you went up $200,000 in value. But during that 10-year span when you rented it out, you also took depreciation. So on the $200,000 of gain on the appreciation, you pay 15%. Now, if your gain exceeds $425,000 if you're single, or $476,000 if you're married, then anything above that you pay 20% on. So somebody that has a property that's owned it for many years and has really significant gains, they can get up into the 20% range on a federal level pretty quickly.
Right. And specific to Fusion, if you haven't lived in the property 2 of the last 5 years, that's in any rental property where this will apply, 2 of the last 5 years.
And it's also so they also look at the last use of the property, right? So, but if you live in a property for 2 out of the last 5 years, you can exclude up to $250,000 of gain if you're single, or up to $500,000 if you're married and filing a joint return. So obviously, if you've lived there for the last 2 of the last 5, if you sell it, you can take advantage of that 121 exemption and take that money tax free.
Right.
And it's not a rollover provision. So when you're with your primary residence, you don't have to reinvest the money. You can just take it and put it in the bank. You don't have to reinvest it. But on the 1031 side, if you don't reinvest it, then you're subject to these taxes. Right. So what we're talking about here is essentially if you sell investment property and you decide not to exchange and you just decide to pay taxes.
Right.
So on the recapture depreciation, so one of the advantages of owning investment property is that you can write off the improvements, or the improvement value of the property when you purchased it. So if I bought a property, let's say for $500,000, I could probably allocate at least $300,000 to the improvement value of it, and I could depreciate that over 27 and a half years. Well, before tax reform, it was 27 and a half. Today it's 30. And so if I took that 300,000, let's say divided by 30 years, that would give me $10,000 a year that I could write off against any, money that the property made. So any rental income that I received, let's say I received $15,000 a year in rent, I could write $10,000 off and shelter it against any of the income that it produced. But when I go to sell it, if it's 10 years later, right, and I've taken $10,000 a year, I've now taken $100,000 in depreciation. I've got to pay 25% of that back to the federal government in a form of a recapture depreciation tax. Now, one of the taxes that's up on there is a little known tax, which is the Affordable Health Care Act tax. And basically, if your gain exceeds $250,000 a year, or your income is over $250,000 a year, then essentially you're subject to another 3.8% in taxes. It's a nice kicker that a lot of people don't realize that exists. State of California, you're going to pay somewhere from 9.3 to 13.3%, depending on whatever your income level is. The idea, obviously, behind that is that we don't want to pay taxes. The idea behind 1031 is, to go exchange it for a new property. So on the screen now are some reasons why people do exchanges. A lot of people right now, are looking to retire from their works, right? So you've got the biggest number of U.S. residents turning over the age 65, the baby boomer generation. In fact, there was a staggering number I heard. It was like 10,000 people a week or a day right now are turning over the age 65. It's an incredible number. So as these people are looking to retire, they may look to increase their cash flow, right? So typically, single family, residential type of investments are great for appreciation purposes. So they go up in value quite a bit, but they don't do great for return on investment. So the equity that you have built in, there's typically a lot of dormant equity. So some people are going into traditional types of investments that produce maybe not as much appreciation. So the property won't go up in value as much, but it'll produce more cash flow. And they want that cash flow so they can offset the loss of income they're going to have from retiring from their job. So, other reasons, reduce operating expenses. Maybe they'll go into something that's more of a passive type of investment, increase net worth. Some people, exchanging obviously to, increase their net worth, reduce risk. Management intensive is a big one. So we're seeing a lot of people go from, management intensive properties where they have tenants into passive types of investments like triple net leases and things like that. So that's a big part of it as well. Consolidate. Some people that may own multiple properties in different locations may want to look to sell multiple properties and exchange them into one property so they can kind of consolidate them. We also have the other side of it where people that want to diversify. They maybe own, maybe a large property, and they say, listen, I've got, a lot of eggs in one basket, so I want to maybe sell that asset and exchange it into several properties located in different parts of the country, or different markets, so that I can kind of diversify myself and kind of shelter myself from, from that kind of deal. The other thing that we see people doing right now is they're selling investment property, exchanging it for another investment property with the ultimate goal of making it their retirement home. So there's nothing in the tax code that says I have to hold this property as an investment forever, right? What the rules say is that I have to buy a property with the intent of holding it for investment or business use. Well, within Section 1031, there's a revenue ruling that says any property that's been held for 2 years or more as an investment, in an audit, the IRS can't challenge the held for investment portion of the exchange. So if I sell my property here, let's say I decide it's too expensive for me to retire in California, I'm going to go retire in Phoenix, right? So I sell my property here in California. I 1031 exchange it for a property in Phoenix. As long as I hold that property in Phoenix for at least 2 years as an investment, once I've done that, I can kick the tenants out of it and convert it to my primary residence or a second home or my retirement home. So we're seeing a fair number of people do that right now as well.
Does that have to be the first 2 years or any 2 years?
The first 2 years.
Okay. than
Yeah.
the first 2.
Yeah. So you want to make sure that you're you're using the first 2 years as the investment part of it, because the rules say in an exchange, you've got to buy a property that's held for investment or business use. All right. So one of the things that this is kind of a basic overview structure of working with what they call a qualified intermediary. It's what our company does. We basically help facilitate exchanges. We're kind of like an escrow between the 2 escrows. So what you have is the relinquished property, which is the property that you would like to sell, right? And so you decide, hey, I'd like to sell that property. We go out and we list the property for sale. We market it like we would any other property. When we get an offer, we counter that offer with some kind of language in the contract that says that my client's going to be doing a 1031 exchange, right? The seller's option to do an exchange. And then that property then goes into escrow. Escrow officer will, now one thing I would suggest, if I back up a step, is that when you're doing an exchange, like working with somebody like you and doing some advanced planning is probably the most important step of the process, right? So it's great to sell a property that you have a bunch of appreciation in, but what's more important is figuring out what you're trying to accomplish by selling the property, right? We kind of talked about that earlier, which is, hey, you know what? If you want to sell this asset and go buy, a property in, Phoenix, you got to figure out, okay, how challenging is that going to be? Are the properties in Phoenix on the market that I want to, I'd like to, live in, or I'd like to rent, or what does that market look like? So it's important before you even really want to list your property for sale, to start talking to somebody like you so that they can, kind of go through the process of, okay, I want to sell this asset. This is what I want to acquire. You can kind of take them through that process of how that whole thing's going to work.
And so part of that process is, once we list your property for sale, after you close escrow, and you can correct me if I'm off, but you have 45 days after closing to identify 3 potential properties that you would like to purchase.
Yes,
correct?
That's right.
45 days. And after the 45 days, you have to buy one of those 3 identified properties. Within 120 days, you have to close escrow on one of the 3. If it's not one of the 3, then they're subject to the tax.
Right.
That's where it's tricky, because 45 days goes really quick.
Right.
And so when I list a property for my sellers that are planning to do this, I have them make it contingent on finding a suitable replacement property.
Yeah, you can put that clause in, or you can also just build some extensions into the escrow period.
Right.
You know, what I typically tell clients is that, your standard contract, you have a financing contingency that's how long?
Typically 21 days by the contract. Right.
So 21 days before escrow closes on their sale, right,
Mm-hmm.
they can aggressively start pursuing properties because they have that built-in contingency in any offer that they make, right?
Mm-hmm.
So, for some reason, if their sale has an issue, they've got an out, right? So you can kind of add that on to the 45 days. So now they're like call it 66 days, right? Now, if you can build some extensions in,
Mm-hmm.
That can buy them some time too. So if you get to the close of escrow, you haven't found what you're looking for, you have the right to extend escrow, let's say, for 15 days.
Right.
Well, if you add that 15 days onto the 66 days we already have, now you're like at 81 days, right?
Right.
And if
the trick is finding the right buyer that will be willing to be flexible enough and willing to give the extensions, because sometimes they're looking and they might get tired. I've had that happen before where they went and found another property.
Yeah.
But, it's just a matter of finding the right fit.
Right. And I think that, like I said, advanced planning, going back to that, is really the key,
Mm-hmm.
right? And so, property goes into escrow. Hire a company like ours, will assign into escrow as the qualified intermediary. Sale closes, then you have that 45 days to identify property. Mm-hmm. You talked about that 3 property rule. Mm-hmm. There also is a 200% rule, which allows people to identify as many properties as they would like, as long as it's not more than twice the value of the property that they sold.
Oh.
So if they sell for, let's say, $700,000, they could identify up to $1.4 million worth of real estate, in any denomination.
Mhm.
Under the 3-property rule, it doesn't limit the value of property you can identify, it just limits the number of property that you can identify.
Well, that's good to know.
So typically, the 200% rule is used for somebody that wants to diversify. They're selling a large asset, they're going to buy several smaller assets. So once you get past the 45 days, you have another 135 days to get it closed.
Oh, is it 130? I thought it was 120.
135. So it's 45 plus
Okay.
135. It's a total of 180. I had a client that was talking to me on the way over that said he thought he had 180 days to reinvest. And I said, you do, but you have to identify that property within 45 days.
Right.
And you're stuck with what you've identified. You cannot change those properties. So it's important that you get through the due diligence as quickly as you can in inspection so that we can get to the other side of that.
Well, and the scary thing about that with the 3 properties is if you're buying in a hot market, those 3 properties may or may not still be available by the time you.
Right.
So it's a little bit tricky there. So
yeah. So you want to be really aggressive.
watch out
if you can get something under contract and in escrow before your sale even closes, that's the best case scenario. So let's.
Or even be in escrow before you list the property, if possible.
Yeah, you can do that too.
Yeah.
So people also use it for estate planning. 1031, I was talking to the gentleman on the way here, and he owned this piece of land that he bought for almost nothing. And he's selling it for, I think, around $3 million. So it's a very significant gain. And he wants to leave the money to his wife, but he doesn't want to pay the taxes associated with the sale of that property. So he is doing a 1031 exchange. He's going to buy other real estate.
Mm-hmm.
So when he passes away, his wife will get a step up in basis, which will eliminate the taxes that exist. So she could sell the asset when he passes away, after he passes away, with a step up in basis and essentially eliminate the capital gains taxes. So it's a good estate planning tool as well. So this is an example of one of my clients actually owned a large office building actually in Torrance, surprisingly. He was going to sell the asset, pay the taxes, and I said, Ron, why would you ever want to do that? And he said, listen, I've got 3 boys, and if I keep this asset and I pass away and I heir it to them, all they're going to do is fight. And so I said, well, why don't you do this? Why don't you sell it, do an exchange, let the boys pick the asset that they want to acquire. So break it up into 3, right? And each boy can pick out their own property that they want to acquire, right? So that, if one outperforms the other one, it's not your fault as the parent, right? It's, the son was the one that picked it. And then when you pass away, they get those individual properties. So so it worked out really well. These are some other reasons. We talked a little bit about these, non-tax reasons for exchanging. The one thing that I wanted to cover here is that we're seeing a huge segment of the market go into what they call triple net lease properties. And I think a lot of people kind of don't know what those are off the top of their heads. And you see them kind of all over the place. There's like Walgreens, Walmart, Dollar Tree, McDonald's, Carl's Jr. Somebody owns those properties. And it's not typically the tenant, right? It's typically somebody that just owns the land in the building and then the tenant pays them rent. But the nice thing about those types of assets is that there's no management responsibility, right? So if I own a Jack in the Box is responsible for the maintenance on the property. They're responsible for the taxes on the property. They're responsible for the insurance on the property. And so I just collect a check every month. So it's a really, an interesting and passive form of ownership that's become kind of a big part of our market. Diversification, we talked a little bit about that. What to look for in a QI. So exchange companies aren't all created equal. It's important that when you look for one, that you look for one that, that has good security of funds, if you can get a third-party performance guarantee, fidelity bond, we have a $100 million guarantee, errors and omissions coverage, all of these types of things. And the reason why these are important is because our industry is completely unregulated, right? So you're regulated by the DRE, Department of Real Estate. You've got title insurance are regulated by the Department of Insurance. Escrows regulated by the Department of Corporations.
And even termite companies are regulated by the state pest
Right.
control board.
Yeah, so now you've got an industry where people are, giving the money from your sale over to this exchange company,
Wow.
and they have no way of, kind of being regulated. So it's important that when you choose a company that there's a company that, that's sufficient, that has sufficient assets. And this is kind of talks a little bit about that. Now we've kind of gone over, the basics of 1031. Is there anything that I didn't cover that you think that your customers would want to know about?
I think you did a good job explaining the basics and some more advanced as well. I think the key is finding the right company to work with and having a good team as far as the tax accountant, the QI, and the real estate broker, and escrow, and just having everybody know what's going on, what the goal of the customer is, and getting them from where they are now to where they want to be.
Yeah, I always tell clients, when I first talk to them when they own an investment property, I would say, if you could sell this property, buy anything, what would you want to buy? As long as it's real estate, we probably can figure out a way to exchange it. Like I had a client that sold off an investment property and wanted to use the money to buy a ranch, right, where he was going to live. And I said, well, as long as the ranch portion of the property is equal or greater in value to the property that you sold, it'll work, right? We can carve out the personal property portion of it, exclude that, but look at the investment portion of it. As long as the investment portion is equal or greater, it'll work. So I think a lot of times, our customers know a little bit about 1031 and they go, well, I'm just going to sell this and go buy something, identical to it. Why would I want to do that?
Right.
But they don't realize all of the things that they can kind of get done with 1031.
Right. Yeah, it's a great planning tool, and having someone on your team like Greg would be very well worthwhile. And Greg's information, again, is on the screen. The website is there below, ipx1031.com. I think your information is there on the next slide, or back on the first slide.
I think it's on the first slide.
Anyway, again, if you're watching this live with us, feel free to send us questions. If you're watching at a future date on our YouTube Fusion channel, feel free to send us your questions either to Greg or myself, and we'll be happy to discuss with you more in detail about your specific situation.